Now, beware the next GDP report. That's the warning from my next guest. He thinks investors should be wary of buying stocks right now. Joining us from Sacramento, California, we have Keith Springer. He is the president of Capital Financial Advisory Services. Keith has about 2 decades of experience in the financial industry, beginning with Merrill Lynch in 1985. Keith Springer, welcome to Bloomberg. Why so bearish? Why are you gloomy?
Well, there's simply no aggregate demand in the economy. It's very simple. The economy is not generating any aggregate demand, and it isn't possible for it to do so. The country is basically out of spenders. The generation of spenders, the baby boomers through the 80s and 90s, is now older. They're not spending, they're saving. They don't have the ability or the wherewithal to spend, and therefore you're not going to see the aggregate demand, and GDP is just going to come in much lower than expected, and we've already seen continued downgrades. And whenever you see 1 or 2 downgrades, they usually fall in place, and that's what scares me the most.
But, Keith, what about the results from companies such as Coca-Cola? I mean, aren't there possibilities of investing in U.S. companies that are showing growth because of their operations outside the country?
They are showing growth, but aggregate demand is still going to have to follow the developed world. The emerging countries, which is where much of those sales are coming from, the developed world is aging. And although emerging markets still has a long way to go and a lot more growth potential, the developed world, U.S. included, Europe, is in an aging stage of population, which is going to create less demand. And that's going to continue because if the emerging markets cannot borrow or don't have the credit markets available, then they're not going to be able to expand into debt markets and such. And so they're not going to be able to grow. You know, the old saying, if the U.S. sneezes, the world catches cold. And that's where we are with this continued problem of no demand. There's no loan growth in banks. Without loaning, the banks can't create any growth, so therefore the economy can't grow. And so you're not getting any type of growth. Let's face it, $12 trillion worth of stimulus, we should have more than 2% GDP or 3% or 4%. We should have be 8 to 10%. And without it, we're in a heap of trouble. I think there's a lot of deflation coming. Doesn't mean it's not a place to make money. I mean, that's exactly what we do for our clients. We find opportunities. There's plenty of safer places to be and still do very well. But you've just got to be very cautious because the market is not a rational being. The market is an irrational monster, and it reacts both ways. It overreacts one way and then the other. And what's going to happen is if we have information that is not positive to the economy and the markets, it's going to overreact the other way and sell off more than it should. And that's the scariest part about this economy and this market. And that's what we do for our clients, to protect them, also find opportunities, just not to be too risky going forward right here.
So, Keith, where are these opportunities right now in an environment which you're describing as potentially deflationary?
Deflationary environment really benefits bonds, particularly short-term bonds. I think deflationary situation is very short-term, a couple of years until the government inflates its way out. They're printing money as fast as they can, and they're going to continue to print it until we get inflation. But the problem is they cannot create inflation as fast as assets are being destroyed. So you still will see deflation. So you look at bonds, you can still find some great yields on 1, 2, 3, even 4-year bonds, 8, 9, 10%. High dividend paying stocks like some MLPs, but I do believe that GDP figure is going to come in less than expected. And Goldman just lowered the estimates to 2%. Hey, it could come in at 1 or 1.5, and we could see a huge sell-off on this market, 500, 1,000 points, maybe 1,500 points, and it's not going to bounce back because of the irrationality of it. And that's where we are right there.
All right, I want to thank you very much. Keith Springer coming to us from Capital Advisor Services. Coming up next, we're going to talk to a chief executive